We mentioned earlier that some companies may choose to use the periodic inventory system instead of the perpetual inventory system. Normally, these companies have either less volume or a simpler type of inventory that they don't need to keep track of inventory on a regular basis. When we record items under the periodic inventory system, we still need to recognize revenues when the sales are made. However, we do not recognize cost of goods sold at the same time as the sale. Rather, we wait until the end of the period to compute how much inventory we had on hand for sale, otherwise known as cost of goods available for sale, and then we subtract out the ending inventory to determine how much the cost of goods sold was. We create an account called the purchases account, which allows us to know what the total purchases are, and then we could net the discounts and the returns and allowances to determine what the net purchases was. Also, we want to include the cost of freight and any other costs associated to getting the inventory to the seller's location and making it ready for sale. So here's an illustration. On the basis of the sales invoice that we previously seen in other videos and the receipt of the merchandise ordered by the seller, this is what the buyer would have to recognize under the periodic inventory system. They would recognize an increase to purchases of $3,800 and a credit to accounts payable. So we would debit purchases $3,800, credit accounts payable $3,800. At the end of the period, this purchase account would be zeroed out, very similar to a temporary account, but this amount would end up going into inventory. The freight costs of $150 would be included in the cost of the purchases. So we would debit freight in because that's a separate line item in the formula for determining goods available for sale, and then we would credit the cash that we had to pay in order to get the product to our location. When the buyer returns product to the seller, the buyer no longer owes the money, so therefore we reduce the accounts payable by the $300, and we would recognize that we returned product and not reducing the inventory account, but rather reducing or increasing the purchase returns and allowance account, which is a contra account to reduce the purchase. Purchase discounts of paying the invoice early would also not reduce an inventory count until the end of the period. Instead, we would show a purchase discount of the $70, which would be a contra to the purchase account. We would no longer owe the $3,500 in accounts payable. We would pay out the cash of $3,430, but would recognize the contra account purchase discounts for $70. Now think about it from the sales perspective. Under the periodic inventory system, the seller would only have to recognize the sale. So we would debit accounts receivable, credit sales revenue. We do not have to recognize cost of goods sold at this time because we'll calculate what the amount will be at the end of the period. When a return comes, once again, this entry is the exact same entry as in a perpetual system. We recognize the sales returns and allowances, and we recognize that the customer no longer owes us the $300. The difference here is that we do not recognize the inventory coming back, so there is no entry to reverse the cost of goods sold. When the customer pays and takes the discount, this entry doesn't change in that we still recognize the cash, we recognize the sales discount, and that the customer no longer owes us the $3,500. Here is a side-by-side comparison of the journal entries that have to be made between the perpetual and periodic inventory systems. What you see here on this screen are the journal entries that are made by the buyer. Notice instead of using the inventory account used in the perpetual inventory system, the periodic uses purchases. Instead of increasing the inventory account for the freight that's paid in the perpetual, the periodic uses freight in. When we look at the purchase returns and allowances, instead of recognizing a reduction of inventory for items reduced, we put it into the contra account called purchase returns and allowances. And finally, the last one, in a perpetual where we take the discount reduces the inventory value. In the periodic, we recognize the contra account purchase discounts. On the seller side, note the periodic inventory changes. The sales itself does not change. We still debit accounts receivable and credit sales revenue. The difference is on the May 4th activity. The perpetual needs to recognize cost of goods sold, whereas the periodic inventory does not. Taking a look at the May 8th entry, both record the debit entry to sales returns and allowances and the credit entry to accounts receivable. The difference is the perpetual system needs to recognize the inventory coming back to the seller and the reversal of the cost of goods sold expense. Periodic does not have to make that entry because we didn't make the entry on the May 4th activity.